we have a premium rate schedule which shows different categories of goods imported and their respective premium rates. The rates could be as low as 0.2% of the value that is being imported, but could also be as high as 10%, depending on the riskiness of what is being imported. So to answer your question, as an insurer, what I would probably be interested in are the following. One, what is the value of what you're importing? Very, very important. Actually, they call that the prime factor in pricing, in underwriting of marine. What is the value? Number two, what is the nature? If you're importing glass and another person is importing furniture, wood, you expect that the glass has a higher risk than wood. For most of the time, especially when you're thinking about accident, which is actually more dominant than the fire. Because if it would be fire, maybe fire again would be worse to the wood than the glass. But when you compare the likelihood of a loss, the most dominant peril will probably be an accident as opposed to a fire. So, what is the nature of the goods that are to be insured? Number three, what is the mode of transport? Air transport has been looked at as one of the safest mode of transport. So meaning that if I'm using air transport, the rate is likely to be lower than somebody who is going to use water transport or worse still, road transport. So what is the mode of transport? How is the packaging? Among other things. So they look at a multitude of factors, but the base, the premium rate, the average premium rate has already been determined under the premium schedule, which has been discussed and actually approved by the insurance regulatory authority. But they can load. Loading means that they can adjust it upwards because what we have are the minimum premium rates. But depending on the factors that I have mentioned, mode of transport, nature of good, whatever, are they coming under protection, etc. When they are in a warehouse, are they guarded? Things of that kind. You can load or you could leave it at the minimum. Yeah. So the most important determinant is the value. Insurance brokers play a very critical role in insurance generally. And they still play a very critical role in marine insurance. You know, unlike motor insurance, which is very easy, you have your vehicle, the value is 20 million, it is motor private, they apply 0.4%. With marine, there are complexities. Because along the way, many things happen. Actually, with marine, even the principles of insurance as we know them do not apply the way we know them. The application is different. Like for instance, insurable interest. With a vehicle, when you are buying insurance, when you get an accident, the insurer will require that you prove insurable interest. With marine, the insurable interest can change. It is only required at the point of loss. That's why you have to prove insurable interest. So because of the complexity involved, because of the value, because if somebody is importing a 40-feet container of high-value goods, you are talking of billions of money in question here. You need somebody to give you guidance that is of professional nature with respect to the kind of cover that you need, the scope of cover that you need, the kind of exclusions you should be able to negotiate back into the policy. You know, sometimes you can buy the exclusions back into the policy. In a standard policy, they are saying this is an exclusion, this is an exclusion. But the broker says, you know what, let's buy this exclusion back into the policy by paying an extra premium, because he has seen that in its current nature, maybe it's not broad enough. When it comes to claims, again, a broker will help you as an importer to pursue your claim at no cost, by the way. Brokers do not charge the people they support in risk management. They are paid through commission. The commission is actually paid by the insurer who has sold the insurance cover to this insured. So, in summary, I am saying that in marine insurance, actually it would pay. If I were to import and I was to buy marine insurance, I would desist from going direct. I only go direct if I am very sure of the insurance. I understand it very well. But because there is no extra cost to me, I would rather use the services of a broker so that I get top-notch guidance on the adequacy of the policy, on the scope of cover, whether the exclusions and whatever is okay, on what risk management procedures I can apply to bring the premium down. But most importantly, when it comes to the claim, I should have a hassle-free experience, because the broker will support me in getting the claim paid. Insurance generally is about risk management. And risk management is the foundation of business resilience. Because when we talk of business resilience, we are saying that can the business survive today and tomorrow and next year and the other year? Now, without insurance, I may not answer that question with certainty. You may apply all responsible, professional risk management, risk mitigation, risk control measures, but there are certain things that will always remain. In insurance, we call them residual risks. You could pack your goods very well. You put them on a very good ship, which you think is new and nothing will happen to it, but they find a very stubborn turbulence in water. And among the containers that they are pushing off the ship is yours. It is brand new, it is very nicely sealed, things are packed well, but it has been released because you have to save the ship. So we are saying with even the best risk management practices in place, there is some amount of risk that remains, which we call residual risk. In fact, insurance comes in to manage that residual risks. So I'm saying that in the absence of an intentional and careful way to manage those risks which will always remain, I would argue that resilience would only be a wish. So insurance would help businesses to be more resilient, to be more stable, because they are saying, come rain, come sunshine, there is somebody you will run to. And your business then can be one of your going concern. Just like I had mentioned, the price for insurance, or the premium, will depend on the riskiness of what is being insured, but also on the value. So if you are talking about oil, if you are talking about gas, these are high risk items. And therefore, the premium rate will be high. And because the premium rate is going to be subjected to a high value import, then we expect that the ultimate price will be high. But this is not to mean that it would not make sense to insure, because we have already mentioned that it's high risk. So do you want to leave the high risk to God or to nature? Maybe not. So in fact, for me, I would imagine that the higher the risk, the greater the need for insurance, even when it means slightly higher. than a low risk. Now, again, oil, especially oil, when we talk about oil, there are environmental considerations. So it is very likely that as insurers are insuring some of these goods which have environmental impact, they are likely to damage the environment. They may be imposing certain restrictions or certain requirements to ensure that you are importing, you are following the standard practices, you are following the recommended practices. Because as an insurer, I don't want to insure you when you are going to pollute all the waters through which your oil is coming through. I will not insure you. You must first of all comply with the required standards, then I will be able to insure you. So they may require proof of compliance with all the other standards required of importing highly environmental sensitive products such as the oil.